Welcome to the Deep Dive, where we take a stack of your sources and, well, really try to pull out the most important nuggets of knowledge for you.
That's the plan.
Today, we're diving into something that feels super timely, but honestly, it's timeless too. It's the allure and, let's be real, the danger of chasing those hot stocks.
Ah, yes.
Right.
The ones everyone's talking about.
Exactly. Those companies, everyone's buzzing about them. Their prices just seem to go up and up. It's really tempting to jump on board, right? To ride that wave.
Oh, absolutely. The fear of missing out is powerful.
But our sources today, we're talking investment giants like Benjamin Graham, David Dodd, John C. Bogle.
Mm,
They consistently show that following these trends, it often leads to, well, significant losses.
that's right. So our mission today is really to unpack why. Why is this common strategy, chasing heat, why can it be so detrimental? We're digging into classics like security analysis, the intelligent investor, and
Whoa.
Bogle's common sense on mutual funds.
Okay.
We want to expose those hidden pitfalls, but more importantly, maybe map out a clearer path forward for your own investment journey.
Okay, let's unpack this then. What is it fundamentally about these hot stocks that makes them so dangerous? It feels like everyone, everywhere is looking for that next big thing, that stock that's just going to skyrocket. And it's thrilling, isn't it, to think you found it?
It is. It's exciting.
But what's fascinating here, reading through the sources, is how they challenge the very idea of what a stock actually is in this whole context, especially when it gets hot.
You've nailed Graham's core principle right there. He really hammers this home.
Hmm.
A stock isn't just a ticker symbol flashing on a screen. It's not just an electronic blip to trade on emotion.
Right.
It's an actual ownership interest
Mm-hmm.
in a real business
Yeah.
with an underlying value. And this is crucial, that value doesn't actually depend on its daily share price.
Huh. Okay.
He described the market, famously,
Uh-huh.
as a pendulum,
Hmm.
always swinging, right? Between unsustainable optimism, making stocks way too expensive, and unjustified pessimism, making them too cheap.
Okay, like mood swings. Big one.
Exactly. And the intelligent investor. Their job is to be the realist in the room. Sell to the optimists, buy from the pessimists, be the anchor, essentially.
So chasing a hot stock, that's basically getting swept up on the unsustainable optimism side of that swing. We're buying the hype, not the business itself.
That's exactly it. And Graham saw this happen again and again. He was very critical of what he called new era investment, especially looking back at like the 1927, 1929 bull market frenzy.
Right, before the crash.
Yeah. This theory then emphasized the trend of earnings and pushed this idea that the desirability of a stock was, quote, entirely independent of its price, which Graham just found incredibly absurd.
Independent of its price. Wow.
Yeah. He saw it for what it was, just old-style speculation wearing, a new outfit.
And these aren't just dusty old history lessons, are they? I mean, the sources give examples of trendy formulas falling flat much more recently.
Oh, constantly.
Remember the January effect, this idea that small stocks would just magically pop at the start of the year.
Yep, that was a big one for a while.
Or back in the late 90s tech boom, day traders sending the wrong stock soaring because they mixed up the ticker symbols. That actually
It
happened.
did. Pure mania.
Or that Painewebber analyst, Walter Piecyk, predicting Qualcomm would hit $1,000 a share. The stock jumped 31% that day.
And then,
Fell right back down later. It's like one source said, it's trading as if your underpants are on fire. Just pure emotion, no logic.
that's a vivid image.
Yeah.
And pretty accurate for that kind of trading.
Okay, so here's where, for me, it gets really interesting. We humans,
Mm-hmm.
we seem hardwired to believe that the long run can be predicted just by looking at, like, the last few weeks or months.
Right, our intuition betrays us.
Yeah. If a fund or a stock has been going up fast, our gut just screams it's going to keep going. But
Yeah.
the data seems to tell a very, very different story.
It absolutely does. And this leads to a really important question John Bogle tackles directly. Does great past performance actually predict future success?
Okay, what's the verdict?
Bogle's answer, unequivocal, no. He says flat out, there remains no evidence, none, that superior past performance is predictive of future success.
None. Wow.
He talks about this powerful pattern of reversion to the mean, calls it a first principle of financial physics. Things tend to return to average over time.
Okay.
He gives the example of the Legg Mason Value Trust. Amazing run, right? Beat the S&P 500 for 15 straight years, 1991 to 2005. Unbelievable.
15 years, you'd think they cracked the code.
You would. But then, from 2006 through 2008, it lagged the index by a staggering 43 percentage points.
Ouch. 43 points.
Yeah. And part of the reason, Bogle suggests, is that funds with amazing returns attract huge piles of cash, and that very success, that influx of money, can actually make it harder for them to keep winning. They get too big, too unwieldy.
So it becomes a victim of its own success, in a way. Which brings us back to Graham's idea. Investing based on projection, guessing the future, instead of protection, knowing the value. He called that a fool's errand.
Precisely. That's exactly what Bogle's data shows playing out. Graham himself warned that the average investor just cannot win by trying to forecast market moves.
So what did he suggest instead?
His advice was remarkably simple, really. If you have a portfolio of sound stocks, businesses you understand, expect their prices to bounce around. Don't get panicked by big drops. Don't get euphoric about big rises.
Easier said than done sometimes.
For sure. But his motto was clear. Never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. Let the dust settle. He also pointed out the danger in projecting trends too far.
Why?
Because, well, reality bites. You run into diminishing returns, competition catches up, the whole economy goes through cycles. What looks unstoppable almost never is.
Okay, so we've got the psychology, the hype trap, we've got reversion to the mean, the market cycle, humbling winners. But there's another piece, right? Something else burning investors who chase these hot stocks, something maybe less obvious?
Yes, a major, often overlooked factor is simply cost.
Cost. Like fees.
Fees, yes, but more than just the obvious ones. John Bogle points out that investors themselves have adopted this really short-term mindset, rapid turnover, flipping their fund holdings.
Oh, rapid.
Well, think about this. Annual turnover rates among fund shareholders jumped from like 8% back in the 60s to over 30% more recently. People aren't holding for the long term nearly as much.
Wow, that's a big shift.
And the fund managers, they kind of set the example. Average turnover for U.S. equity funds was around 85% back in 1997. That means they were holding stocks for, what, barely over a year?
So they're trading constantly, too.
Exactly. And all that buying and selling. It burdens you, the investor, with enormous portfolio transaction costs, as Bogle puts it, plus staggering tax costs if it's not in a tax-sheltered account.
Okay, so it's not just the expense ratio, the percentage fee, the fund charges that you see listed. There are hidden costs, too. What are those exactly? Why don't we see them?
Precisely. You see the expense ratio, right? Maybe 0.2% for a cheap index fund, maybe 2.2% or more for an expensive active fund. But the costs of actually doing the trading inside the fund commissions, the market impact of big trades moving prices, the spread between buying and selling prices, those are basically invisible to you. Fund turnover averages, let's say, around 80% a year. Bogle estimates that adds maybe 0.5 to 1.0 percentage points, maybe even more, to that visible cost.
Just from the trading?
Yes. John C. Bogle Jr., his son, did studies showing typical total trading costs are about 0.8% of the value of the trade. So if a fund turns over 100% of its portfolio in a year, which many do,
that's another 1.6% gone. 0.8% on the buy, 0.8% on the sell.
you got it. A 1.6% annual performance penalty that just vanishes. It's not itemized on your statement.
Wow. Okay, so let's add that up. If you take that silent 1.6% trading drag and you add, say, an average expense ratio of 1.5%.
That's over 3% per year. Gone.
10%.
It's huge. Think about it. If the market gives you a 10% return, which is historically pretty good, nearly a third of it could be eaten up by costs and related taxes. Just gone.
It's depressing.
It is. This is what Bogle calls the tyranny of compounding working against you. That higher cost investment just falls further and further behind the lower cost one year after year. The gap gets wider and wider. These combined costs, expenses, trading, taxes, they can lead to staggering shortfalls over decades. We're talking potentially hundreds of thousands of dollars less in your account at retirement.
Okay. Okay, so this paints a pretty bleak picture for chasing trends in active trading. If hot stocks are a trap and costs are this corrosive, what's the alternative? What's the smarter path here for investors who just want to build wealth sensibly?
Well, the secret of investing, according to Bogle, is, wait for it, there is no secret.
Huh? Okay. Anticlimactic, but maybe true.
Right. It really boils down to simplicity. He advises, very strongly, impulse is your enemy. You have to get emotion out of the equation. Have rational expectations for returns, don't expect miracles, and crucially, don't change those expectations just because the market's having a good month or a bad year or some new trend is hot.
Stay the course, basically. Yeah. And a huge part of that simplicity, reading the sources, it seems to point overwhelmingly towards index funds.
Absolutely. It's hard to ignore. Passively managed index funds just offer such a compelling package. Why? Super low costs, they're incredibly tax efficient because they don't trade much, and the data shows they are demonstrably lower risk than most actively managed funds.
And the performance.
Well, Bogle points out that the original Vanguard S&P 500 index fund beat 94% of all other funds before taxes. After taxes, it beat 97%. Yeah. And it's not just Bogle saying this. Peter Lynch, right, legendary stock picker at Fidelity Magellan, he said, most investors would be better off in an index fund. Charles Schwab, same tune. Only about 1 out of every 4 equity funds outperforms the stock market. That's why I'm a firm believer in the power of indexing.
It seems like such a consensus among people who should know. And this ties right back into Graham's original advice about diversification, doesn't it? Indexing is like diversification on steroids.
It's the ultimate diversification, really.
Yeah.
Graham argued that for most people, not diversifying is just foolish. Why? Because it's so incredibly hard to pick the few stocks that'll be big winners and, just as importantly, avoid the many that will be losers.
It's so hard, it's maybe impossible for most.
Pretty much. He concluded the ideal choice for most investors is a total stock market index fund. Simple, low cost, you own basically every stock worth owning. Done. He also warned against getting too fancy, against overly complex, abstruse math in trying to predict the market. He felt it often substituted theory for actual experience and just dressed up speculation to look like smart investing. His take. Simple arithmetic. That's usually all you need for dependable investment calculations. Keep it simple.
So, okay, that temptation to chase the hot stock, be part of the buzz, feel like you're smart and beating the crowd, it's really powerful. I get it.
It is. Very human.
But this deep dive, looking at Graham, Bogle, Dodd, it makes it crystal clear, doesn't it? That path is just riddled with risk. It's plagued by high costs, hidden and visible, and it comes with a near certainty of disappointment over the long haul.
Instead of searching for that mythical holy grail, trying to find the manager or the trend that will magically beat the market, the wisdom from these giants points somewhere else entirely. It points towards simple, low-cost, broadly diversified, and maybe most importantly, long-term.
Patience. It's about the business, not the ticker. Respecting the cycles, letting compounding work for you, not against you via costs.
Exactly. Freeing yourself from that tyranny of costs and those emotional roller coaster decisions.
So what stands out to you listening to all this? Here's a thought. Maybe the real hot stock isn't a single company you chase in a frenzy. Maybe it's just the entire market, owned broadly, patiently, consistently over time, free from that exhausting and probably futile desire to outsmart everyone else. Something to really mull over on your own investment journey.